things of that and things of that sort. But these are just some ideas and concepts to consider when you're investing in vacation rentals. So, talking about um, tax breaks or things like that for vacation rentals, and really any kind of investment. When the IRS, they look at either, are these active income or passive income? So active income would be like your W-2 job, right? That's active income. Or if you own your own private practice, you show up at work, you get paid, right? That's active income. Typically, passive income is from investments like stocks, right? You invest, you get paid, but you don't necessarily run the inner workings of that business. That's passive income. A lot of real estate can be passive income. So, for example, if you buy property and you hire a property manager and you're pretty much hands off, that's considered passive income. So, when it comes to taxes, active losses can only be deducted from active income. Passive losses can only be deducted from passive income. And this is where a lot of people um, don't understand is if you're a passive real estate investor, those losses cannot go against your active income. So if I own a 3 bedroom, 2 bath house that I rent long term and I hire a property manager and I'm pretty hands off, all the tax break for that cannot go against your W-2 or your private practice income because that's active income. So that's just kind of help us understand the active versus passive income. So when it comes to vacation rental, there's a term called material participation. And so when we meet these criteria, this is how we as investors become active in that real estate business. And now that income and those losses can be considered active income or active losses. So as you see listed here are there's technically, according to the IRS, there's 7 criteria that you only have to meet one of the criteria, but there's 7 different ways to qualify for material participation. And here is the top 3. These are the most common. If you work 500 hours in your business, done. You meet the requirements for material participation. If you work essentially the whole part of your business, so they call it substantially all, then you qualify. So, for example, a good thing for that would be at the end of the year, you've owned the property for 30 days. You can't really get 500 hours in 30 days, but you're the only one that's really worked in your business. You did all the design, the decor, all that kind of stuff, then you would qualify. Another possible one or popular one is very similar. It's if you work more than 100 hours and you've worked more than any other person. So, for example, say you bought your house in like September, you worked 100 hours and more than other people. The hard person to outwork in your business is going to be your cleaners because they're the people that are in and out of your house the most. They're the ones that put the most touch on your house because they're cleaning your house in between all of your stays. So that's essentially the person that you're going to have to work more than. And it's per individual or per company. So, for example, I've heard of someone who bought a house in September and he hired 4 or 5 different cleaning companies because he wanted to do more time than they did. So there's some ways to kind of play the game to make sure that you're working more hours than any other individual. Um, some other keynotes here is your spouse's hours do count. So you and your spouse working together, all of those hours would count, but no one else. No kids, no family members, no friends, no business partners. It's just you and your spouse. Another thing to take note is you got to keep track of your hours that you've worked. You need to specifically state generally what you did for those hours. And one thing that a CPA told me is you got to make sure you don't round those hours. So if you said I spent 2 hours because you actually spent an hour and 45 minutes and you round that to 2 hours, that's going to throw a red flag if you get audited. So you really need to keep those hours in non-whole numbers. Okay, so here's some of the other qualifications and criteria. These ones aren't very popular, not very used very often, but these are some more unique other situations that you can qualify to meet the requirements of material participation. And you can find all these requirements on the IRS's website. You can just Google IRS material participation requirements, and you can find the list of 7 things. So if anybody is familiar with real estate professionals, so like real estate agents, they have to meet similar type requirements to meet the qualification of real estate professional. Once again, that's how they get their active status, is through that criteria. So material participation is a similar type qualification for vacation rental investors. So another requirement that IRS specifies is, so essentially, provide a little bit more background, I guess, on this STR loophole. Is this loophole was created essentially back in like the 60s and 70s for hotels. And so what people have realized is we can apply these these tax benefits that were originally developed for hotels to vacation rentals. And this is how they do that: is your average nightly stay has to be less than 7 days, because the IRS wants to give certain tax breaks to certain groups of people. And so their determination for hotel status was less than 7 nights. So if you've had a whole bunch of people stay, you just have to average those bookings and the number of nights that they've stayed and keep that average less than 7 days. So one way we do that is we don't allow bookings over 7 nights, right? A week, or 7 days, 6 nights over a week. Now, it's okay if you let someone stay there for 2 or 3 weeks. You just got to make sure you have a lot of one-night stays to keep that average below the 7. Okay, so that's another one of the criteria that we have to meet. Sorry. So one of the benefits of this loophole is called bonus depreciation. So when it comes to any real estate, there's depreciation that you can offset. Typically, that depreciation is over 27 and a half years. So basically, you take the value of your property, you subtract the land cost, and then you can divide that by 27 and a half years, and that's what you can deduct each year, is that dollar amount. Well, for vacation rentals, you can essentially take all of that depreciation year one. So some of the things that we have to do is we have to get a cost segregation. So we go hire a cost segregation engineer. And there's various kinds. Some people will show up and physically walk through your house. The way we like to do it is by doing a Matterport. So it's a 3D walkthrough scan of our house. We send that to the cost segregation engineer, and they can basically walk through your house and make choices. And the third way is using some standard calculations. So they're not going to necessarily walk through your house. Typically, you get the best valuation from the guy who's physically there, but they also are going to charge you thousands of dollars because you got to pay for this guy's airfare or travel costs. He's got to show up. You got to, all that travel time. And what we found is if we do the 3D scan option, they're essentially there, right? They can't see every nitty gritty corner and nook and cranny, but they can tell what kind of cabinets you have, what kind of flooring you have, all these other kind of fixtures you have, appliances and stuff like that. And so you get most of the in-person evaluation, but you're only paying like $1,300 to $1,500 versus like $5,000 to $7,000. So that person will come through your home, they'll give you an evaluation. They're going to basically say what all your stuff is worth, what your tile's worth, your flooring, all that kind of stuff. And then, because different things have different depreciation schedules. And so basically through a bunch of math and spreadsheet work, he's going to give you a number, and by no means don't hold me to this, but just kind of a rough thing, say you bought a $700,000 house, and he's going to say you can depreciate $200,000 of that $700,000 house. So that $200,000, now that you've met material participation, your losses can be active losses against your active income. So now that $200,000 can be used as a loss against your other active income. So let's say you make $150,000 a year as a W-2 employee. That $200,000 would offset the $150,000. You would have $50,000 left over. That $50,000 can roll to next year and essentially roll indefinitely until it's used up. Okay. So with that comes into some tax law. So previously, we in 2023, we were allowed to use 100% of that depreciation. But because they changed the tax law, there basically is a burn down. So this year, you can only use 60% of that $200,000. Next year, it would be 40% of that $200,000 is what you could use as a depreciation. By no means do I have a crystal ball, but in my personal opinion, we're likely to see Trump change the tax law to get back to having 100% of that depreciation. In the past, the law has typically had a 1 year reach back. So basically, they'll pass the law in 25 and it will go back to apply to 2024. Right. But until that law gets passed and all that kind of stuff, we don't know exactly what it's going to look like. But that's just something to be aware of. So if you purchased a property in 2024, you met material participation, and we'll talk about some other qualification criteria. You put it into service. You don't necessarily have to take that tax benefit now, but you met all the requirements for 2024. So when we talk about putting our property into service, it's got to be rent ready. So basically, we got to have furniture. It's got to be listed. We got to, on Airbnb or Vrbo, and it's got to have pictures. So technically, it's in service if you have a minimum of one reservation, but we'd like to see that reservation for more than one night, so 2 or 3 nights. And preferably, we like to see 2 to 3 reservations. It just strengthens that perspective that we put it into service. Okay. So once we've put it into service, we met those requirements. I'm not sure if you guys are aware of this, but you can basically amend your taxes 3 years back. So in 2025, we're submitting our information for 2024 taxes. In 2025, I can amend 2023's taxes and 2022's taxes. So here's kind of how this would play out in my mind, right? I go purchase a property. I meet material participation. I've worked in my business. I can count it as active income, right? I've put it into service. I've rented it for 2 or 3 reservations for a couple of nights each. I've met all those requirements. But in my 2025 taxes, I don't want to take the 60% depreciation because I think the new tax laws are going to allow me to have 100% depreciation. So we wait, say September of 2025, they passed the law, 100% bonus depreciation. And in the law, it says it goes back retroactively to 2024. So in 2026, I can amend my 2024's taxes because I met the requirements for material participation and I put it into service. I can then take 100% of that depreciation and apply it as a loss to my 2026 income. Actually, 2025's income, right? Because we put the taxes we submit our taxes in 26 for 2025. Does that make sense? Is that kind of going over anybody's head?
Yes, it does. I thought you can go back to 2024 and then claim 100% for the 2024 year,
Correct. And
right?
you would amend those taxes,
Yeah.
and then you would see those benefits in 2025's taxes that you submitted in 26.
Okay.
Right? Because
Cool.
right now it wouldn't make sense to go only get the 60% if we think it's going to go back to 100%. Worst case scenario, that law doesn't get passed. You can amend 2024's taxes to get the 60%. Right? So either way, you're going to get it. You're just
Yeah.
going to have to basically, you're not going to get it in 25, you're going to get it in 26. You may have to pay taxes in 25, but then you would get those taxes back in 26. Okay.
Yep.
So this next thing we're going to talk about personal use. And this is the one thing that I really love about vacation rentals because I don't know about you, but that apartment complex that I bought in BYU, Idaho, I don't have any interest in staying there. There's no
And he's frozen. I'll message him real quick. All right, I just messaged him. I'm just gonna pause the recording real quick.
Let me get back here. You gotta love technology. Technology is awesome when it works. So, um, so the personal use. So the IRS has specified kind of a line in the sand determining between personal use and business use. So if you use your property a minimum of 14 days, then the IRS considers this a business use. Okay. Also, they said so they give a couple of criteria. So you can use it for at least 14 days, up to 10% of the number of nights you've booked. So, for example, say you rented your property 300 nights that year, 10% would say you can get 30 days of personal use. So, as long as you stay less than 30 days, the IRS considers this as a business asset. You can write off all your expenses, your deductions, and all that kind of stuff. Okay. So, on top of that, the IRS has said as long as you spend more than 4 days, more than 4 hours per day, that day does not count towards your personal days. So if there's me and my wife, we do 2 hours a piece. So we get up in the morning, we go do a little bit of maintenance around the house, we do some walkthroughs, maybe we meet with a contractor or something like that. So me and my wife, we spend 2 hours. That day does not count towards my 14 or 10%, so say 30 days. So now I take a trip to the beach, I go visit my property. We're there for 7 days. I can go spend a couple of days working at my business. Me and my wife work 2 hours, or I work 4 hours. She doesn't work at all because I'm here by myself. Now I can write off my airfare, my rental car, my food. All of these things now just became business expenses. Your family and your family members are part of your business. Another way you can strengthen this is by having a family business meeting while you're on this trip. So go take an hour or two, get your family together, talk about how your business is doing, how your properties are doing, what do we want to do to make it better, all these kinds of things. So I went and spent maybe 6 hours that week, me and my wife. Now, 3 of those days don't count towards my 14. Now I can write off all my expenses. So now basically my business is paying for my family's vacations. And so for me, I, I I'm always about looking for things that have the maximum benefit for the minimum input. And so for me, now I have a business model where I can invest in properties that I want to travel to. They make me money, they reduce my taxable income, and now my business will pay for my trips, pay for my costs to go there. And so with all of these things, it's a huge trifecta on maximizing personal benefit with income and reducing my tax basis. This is the reason why I love vacation rental so much, is because of this trifecta. Are there things out there you can make more money? Sure, but I'm not interested in visiting an apartment complex in St. Louis, Missouri, right? And so because of that, you know, we can maximize personal benefits, we can maximize income, we can maximize tax breaks. And so, we've already kind of talked about this, the back taxes. So does anybody have any specific questions? Maybe something I didn't explain very clearly, or a specific question on the concepts. And another thing that real quick, is I found is most CPAs don't understand these things, because most CPAs, number one, aren't experts in the real estate field. And if they are expert in the real estate field, they're not experts in the vacation rental part of the real estate field. And so you really have to find specific people who really truly understand these things. And so, if you guys ever need contacts, we have contacts for lenders, tax professionals, cost segregation. We have a lot of resources that we found that have worked pretty well. Some of these people, for some CPAs, you just have to kind of explain these concepts. Once you explain the concepts, they're like, oh yeah, okay, I understand that and I get that. They just don't understand the terminology or necessarily how to apply the things. But once you kind of explain it to them, they can know how to apply it to your situation. So
I think that's a really important part of this entire process that we've been on, and learning this. It's taken us a couple years. We've gone through some people who, charged $40,000 to do our taxes, or, and we were like, okay, you got to teach us while you do this, or finding good cost seg people that, are reliable, get back to you, do the correct kinds of reports. So we've kind of gone through that. We have that experience where Jacob has made really good contacts along the way, dropped the ones that didn't, weren't congruent with others, really found better tax guys, or he, pretty regularly will pay them for an hour of their time and just question drop and be like, let me pick your brain. What about this? What about this? And just kind of, they're like, okay, all right, we'll keep up. Might have to, look up the code and the tax law and get back to you. But like he said, a lot of it's the interpretation of the law. And so something that I really appreciated his, like Jacob, you've really gone through a lot of different education to get to kind of be able to condense this information. So if you don't want to have to go out and find all those people yourself, but if you kind of have, a way you're going, or like, I know both the guys we have on right now are both doctors. So you guys are like looking for a higher price bracket with a higher tax shelter kind of a situation, then you might be willing to pay someone a little bit more at the beginning as you're setting things up, just so that they can be really, really thorough, or teach your CPA what to do. I know sometimes Jacob's been like, okay, my dad's a CPA, accountant guy. I need you to get on a Zoom call and I need you to walk him through this so he can do it from now on. So there's a lot of flexibility in the industry, but I think we've done a lot of the legwork. So if you have any questions, it's just easier. We can kind of just point at the person that we think would be the best fit.
yeah, and to provide some transparency, Vanessa and I have probably spent about $40,000 in education over the last 2 or 3 years, because we're striving to be experts in the field. We're striving to do this right, and we've made a lot of mistakes along the way, and we can easily share those things that we've learned. Like, so for example, right now we're in the process of restructuring our business because we did the wrong entity structure, because that, with the entities that we have, it would cost us about $20,000 a year to have someone do our taxes. And so right now we're spending about $5,000-6,000 to restructure our businesses. So we're going to spend somewhere to $5,000 to $7,000 a year in the future to have someone do our taxes. So we can share those lessons learned. If you're planning to have multiple properties, we can help you with that structure, because we've learned the wrong way to do it, and we can tell you what the right way is, because we're currently going through that, right? So basically it comes down to is create your properties as single member LLCs and have a
Okay, what I think he was gonna, finish up with is just saying we now restructured to kind of have an umbrella company. And our umbrella company then has single LLCs and then filing those taxes because we had all of our kids and all of, it got a little messy and so it was really expensive. Jacob, do you want to take any questions and then we'll wrap up?
Yeah.
Hey.
Jacob,
Oh yeah. Oh,
hey,
Uh-huh.
yeah, I have two properties and I'm planning to maybe buy one more next year or this year. I'm not sure. So do you recommend getting all the three different state LLCs and put them under an Wyoming LLC?
Yeah, so it'd be a wide.
I'll give him just a second. Seemed like he came back fast last time. We'll see.
North Carolina.
It has 1 gig internet. Like we pay for this like great internet. It even has like a mesh network. It's got, oh, there he
Yeah,
is again.
there we go. Sorry. So yeah, basically
Okay,
what I
okay.
would do is a Wyoming hold.
Oh, the internet doesn't like Wyoming.
Yeah, that's right.
It says I'm the host again, so he must have gotten kicked out. Maybe if he just does it audio. Just do audio. No picture.
So each property you've put into its own LLC.
Yeah, we just changed that well, usually you start that at the, like anyway, even if the property is in your name, we always have an LLC, but for us, it was never just us as the purchasers. We were taking our kids' college funds as well. And so there was always like a division of the property. And so it always made our tax code very different. If it's just when we went through and just did our own, the properties we did it just in our name, then that was a different situation.
You guys hear me?
Yep,
Yeah.
Yeah, I'm back. Sorry,
you're good.
it's been a struggle. So yeah, so the reason why we do the LLCs is for asset protection. The reason why we do the Wyoming holding company is for asset protection. So ultimately, what we're trying to do is we're out here spending a lot of time, money, and effort to grow our business. We don't want someone to come over here, whether they do slip or fall or not. There's a lot of people out there who are doing, insurance fraud. We don't want them to be able to take everything that we've built.
Mm-hmm.
So what we do is we make sure we have good insurance that will cover people's medical bills. Because, to be fair, if someone gets hurt at our property, we want them to be taken care of. So we have the insurance to cover that. So we have separate LLC. So for example, if someone comes and sues us, they can only sue and potentially take the one LLC at the property they were at. They can't have any of the other LLCs because they're separate businesses. So worst case scenarios, they come and take one property versus taking all of our properties. Because if all the properties were under one LLC, they could sue that whole LLC for everything and potentially take it all, right? And in your guys' specific situation, right? Since you are a doctor, right? In our world, doctors are seen as wealthy people, and sometimes you guys do get targeted because of that, right? We want to be able to make sure we have great asset protection. So one part of that asset protection is anonymity. That's why we use a Wyoming LLC holding company, because in Wyoming, they are not required by law to share your personal information on who owns that LLC. So what we do is we set up an LLC, multi-member LLC in Wyoming. It's our holding company, and it's the one that basically has all the businesses within it. And those are single member LLCs because we want each individual property to have their own LLC. Now, if you happen to buy a couple of small properties, you're buying $100,000, $150,000 condo somewhere. Yeah, maybe you can have two or three of those in one LLC because you bought three of them at the same place, right? But a lot of it is if you have different assets in different states, you got to have a different LLC in those different states. Okay. Another thing to be aware of that we learned the hard way is when it comes to a lending perspective, is if you're trying to have this anonymity for your asset, for asset protection, you shouldn't be getting loans in your personal name. Because as soon as you get that loan in your personal name, that is public information. People can go find out who owns that property through who has that loan. So we want to be getting loans in business names, right? We've learned that the hard way.
Yeah.
So we're
So
having
how
to.
do you offer the service of creating Wyoming LLC and integrating it, or do you have somebody who can help us?
Yeah, I'm currently using Prime Corporate Services based out of Utah to restructure my business right now.
Mm-hmm.
So we're doing a trust and we're restructuring 4 businesses, and it's costing us about $5,000.
Okay.
So they do all the entity, they do the operating agreements.
Mm-hmm.
They help you with the BOI. Have you heard about the new tax thing for, what is it, the beneficial owner report or something like that? That if you have a
No.
business.
No. Mm.
So here's something you guys should be aware of. If you currently have a business, which both of you probably do, you have to file a beneficial ownership report by end of the year with the IRS. Otherwise, you're going to get fined $500 a day come January 1st.
My goodness.
You have until end of the year for previous businesses till 2025. If you establish a new business in 2024, you have 30 days. And you go on there.
You mean 2024 or 2025? But to establish a new business.
2024 is what I meant. So for example, we just created a new business in 2024. I have 30 days to go file that I think it's beneficial ownership report, BOI. I don't know. Anyways, I don't remember the exact name, but if you need some help with that, I can help with that. I've only filled out like 5 or 6 of them in the last couple of weeks for all of our properties, and now I got to go fill out another 4 or 5 more from the restructure and all the new ones that we're doing. But like, for example, this Prime Corporate Services, they'll do all the paperwork, they'll send it to you. You just got to sign a couple things and they'll file it for you. So
yeah, oh, that would be great because I don't think I've done it.
Yeah, you have until December 31st. And then after that, you're getting charged $500 a day.
So we have to go through the LLC to do it, or how do you find out?
It's on the IRS website.
IRS, okay.
Yeah, just Google the BOI. They have their own website. It's called FinCEN, the Financial Secretary of State or something like that. So basically what their justification is, and to be honest, the report doesn't really provide any information they don't already have, right? Because when you file for a business, they ask for your they give you a federal tax ID number, so they have that. They ask for your address, right? They ask for some social security numbers. They already have that. They ask for your driver's license or your passport. They already have that, right? Basically what it is, this is my personal opinion, the government and various organizations collects a lot of information, but they are the worst at sharing information amongst each other. So the DMV has your driver's license. The passport office has your passport photo, right? The Secretary of Business or whatever, Department of Business has your tax ID number for your business. They just want you to put it all together for them. And so basically you're just filling out this report and it's confusing. You know, it takes probably 15 minutes to fill out the report. But basically they're justifying it because they passed a law this last year about trying to prevent some money laundering. And they're using this as a justification to have everybody fill out these reports is to quote unquote help prevent people from laundering money. But basically, they're just too lazy to collect all the information amongst all the other government organizations. They want you to provide it for them. So it's a very it's very interesting because, like I said, I'm giving them all this information that they already have.
Yeah, so they're scaring business owners. They're going to charge $500 per day if they don't file it.
Yeah. So, but Any other questions?
No, thank you very much. That was a great, great,
So
lots of information.
do you have to have a Wyoming property to have your LLC holding company
No, you
in
don't have
Wyoming?
to. You don't
Oh,
Nope,
have to.
not in Wyoming.
Yeah, you can just open an LLC and then put these two LLC into the Wyoming LLC.
Mm-hmm.
You can piggyback it.
Because for example, what we did is, I wanted my wife to be a partner in my business. And so we created a multi-member LLC thinking that was the right thing to do because if I die, then she gets to be able to still run the business, right? Well, if you have a multi-member LLC, so basically it's an LLC, but the IRS taxed that as a partnership. Well, that means I have to file a tax return for that. Most CPAs are going to charge you $1,500 to $2,000 just for that return. Well, if you own 4 or 5 properties, right, there's $8,000 in just tax returns for those properties. Now you have your personal return you have to do, right? All these kinds of things. So what you do is each of your properties is a single member LLC. Well, with a single member LLC, that income is just that business is just a pass through. You don't have to file a tax return for that single member LLC. So you have 4 or 5 of these properties. All the income would pass through to the Wyoming LLC, and then that Wyoming LLC is the one that would file a tax return for all of your properties. So one tax return, just $2,000 versus $8,000 for all your properties. Now, if you're expanding this to 10, 12, 15 properties, that can get pretty expensive just on tax returns. So,
Amen. That's how we feel. Okay. Jacob has his personal information. I'm going to stick it in the chat. If you guys have any other specific questions, I know you guys both have his cell phone, but if you don't, here it is. And if you guys have any specific, oh, I missed a number. If you have any specific information that you think about and want, some information on, you can give him that. You can also just text him that, like, hey, send me the information from today's meeting, and he can send you anybody's personal information from that business that he shared. And I think he can kind of, Jacob, can you get together all of your contacts for certain things and just prepare it in like a single text message with everybody's information?
yep.
Okay.
And they're pretty good because they'll do like an onboarding call. They'll walk you through because different states have different costs. They basically we did like a planning meeting. And then after we did that, then they basically did like an onboarding meeting where they went through, they asked for some personal information. They build all the different businesses. And then in like a couple of weeks, their person who's going to do the trust, we're meeting with that person because trusts are pretty complicated to set up. There's a lot of information you have to share and stuff like that. And so, over the process, I said, can we have this done by the end of the year? And he's like, yeah. So basically, we're creating a trust, restructuring 4 businesses, setting up 2 new businesses before December 31st. So a month and a half.
Yeah, they're good at what they do.
So, yeah.
All right, guys. Awesome. Jacob, we'll let you go. I know it's late over there on the East Coast. But thank you guys for joining us today. We appreciate it.
Hey, thanks so much
Thank
for your
you.
time.
Thank you both. Yeah.
Thanks.
Thank you both
Thanks,
for
guys.
helping us.
You betcha.
See ya.